Welcome back. Today we'll be looking at 4 stocks that I'm personally buying in April 2025. Now, don't get me wrong, there are plenty of other opportunities out there right now, but these are some of the best risk rewards in my opinion, and the ones that I chose to go with based on my portfolio distribution and position sizing. Let's not waste any more time and jump right into stock number 1, SoFi. SoFi stock is down almost 36% from the peak in January. The main reason for SoFi's decline recently is because it is seen as more of a growth stock and perhaps still a little speculative. So when the market goes risk off, SoFi just hurts. And of course, when you invest in a company that lends money to consumers, you're always taking the risk that those consumers don't pay their debts when they come due. So you kind of have to trust the management team that they're being somewhat picky with who they're lending money to and not over leveraging and going bankrupt. And based on everything I'm hearing from the management team and the way they sound during earnings call makes me, confident that they are doing that. And another reason the stock is down recently, in my opinion, is because investors haven't been happy with the future projected EPS for the next year. However, in my opinion, I could care less about the short term EPS. They're currently focused on acquiring more members, generating revenue, and taking market share. So when they do finally turn on the profit machine, the EPS will look much better than it would today. If we pull up SoFi on Qualtrim, you can see the valuation here. At a forward PE of 39 and a 2-year forward PE of 23, this stock is a buy in my opinion. And remember, forward PE ratios are based on what analysts are expecting for the company in terms of EPS. So here, since the 2-year forward PE is so much lower than the 1-year forward PE or just the forward PE, that essentially tells us that analysts are expecting SoFi's EPS to grow very fast in about a year. And since the company just flipped to profitability and they're not even focused on earnings right now, their EPS could really explode in the coming years. And then they would likely eat up those EPS estimates. And if they do so, analysts are going to have to redo their EPS projections, and investors will suddenly realize how undervalued the company is. If we look at some of their metrics here, they grew their revenue nearly 22% year over year in the last quarter. And if we look at their members, they grew their members by over 34% year over year. With their new member incentives and marketing, they're really attracting a lot of the younger generation, the next generation that will start earning more and more in the future and doing more business with SoFi, both by, having more money in the bank and potentially by, taking out personal loans and mortgages and stuff like that. SoFi currently has such an advantage because they have no physical branches, unlike other banks. So they can spend their money on advertising and bringing in more members, developing their platform and really making it better than any other product out there. SoFi currently has a market cap of just over $13 billion. However, that is absolutely nothing compared to JP Morgan at 680 billion, Bank of America at 315 billion, Wells Fargo at 232 billion. So SoFi is currently taking market share, but the question is how much can they take over the coming years? I personally see the company becoming a $100 billion company in the future, simply based on the quality of their product and their platform, and because their drive to, become this all-in-one financial platform for all money related things. So let's move on to some of the potential catalysts coming up for SoFi. First, if we can start seeing some rate cuts from the Federal Reserve in the next 2 years, that could really get the housing market going again, which could then lead to an increase in mortgage loans with SoFi. So I think that's honestly a pretty big catalyst for SoFi moving forward. And we know that the Federal Reserve is currently in a cutting cycle. So unless tariffs absolutely screw that up, we could see a lot of cuts in the next 2 years. And the second potential catalyst I see coming is the loosening restrictions around financial institutions holding crypto assets and offering crypto assets. And remember, SoFi already offered crypto in the past, so that code and that platform must be around somewhere. And with the excitement around crypto recently and the boost that the Trump administration has really given that whole space, especially if they announce that when the market goes risk on again, just wait. SoFi stock price is probably going to boom. Okay, moving on to stock number 2, ASML. As you can see, I also hold this one. I'm currently down around 10% on my shares, and it's around the same size as SoFi, just over 6%. I've been describing this one as the forgotten monopoly. If you haven't heard of ASML before, here's essentially what they do. ASML is critical in the semiconductor manufacturing process and the continued innovation of chips or semiconductors. Specifically, they're in the business of providing specialized machines to semiconductor manufacturing facilities, and they're one of the biggest players in that rapidly growing market. I call this company a monopoly because they focus in on and really control one part of the semiconductor manufacturing process, and that's lithography or patterning, as you can see here. You can also see that this is the biggest, most valuable part of the semiconductor manufacturing process. And based on this share here, they hold around 70% of it as of 2023. ASML makes these ridiculously complicated and really expensive machines that cost around $350 million each and take up to 6 months to assemble at the client's facility. Not only do they sell these machines, but they also sell their services, both in setting them up and maintaining them with the client, so they have this ongoing like subscription like revenue stream, because the machines would be pretty much useless without ASML's expertise. Another reason I call this company a monopoly is because they are literally the only company in the world that can make their most advanced and most precise machines, the EUV machines. No other company can match this technology, which is essential for making the most advanced semiconductors in the world. This company is down almost 40% from their all-time highs, and that has, resulted in this monopoly, as I've been saying, trading at a forward PE of around 27 and a 2-year forward PE of just 22. When a company has such a competitive advantage over other companies and such a strong moat, they typically trade well above the market average. But as of right now, ASML really doesn't. And while this is a pretty big $260 billion company, they're still growing revenue around 20% per year. In the past 5 years it's 18, in the past two it's 20. If we look at their free cash flow, I'm going to switch this to the trailing 12 months. Their free cash flow is a little bit more lumpy, but you can see that during good times they really generate a shit ton of money. And if we look at the EPS, in the past 5 years, EPS has been growing at 25% per year. It's also a big focus of the management team to return value to shareholders through both dividends and share buybacks. Currently, they're paying a dividend of, around $6 per share, which, let's see, is around a 1% dividend yield. But also, when they generate a shit ton of money, they buy back literally billions of dollars worth of shares, as you can see here. And that essentially increases your stake in the company because they take those shares off the market or retire them. And that's what you'll see in the shares outstanding chart. The shares are just slowly, going down over time. If we look at the valuation chart here, and this is tracking the price to earnings over a 5-year period. At this point, the company is almost trading as cheap as it was during the 2022 crash. So you'll see during 22, their PE ratio was around like 20, 27, 28. And now they're getting down to 30, 34, 35. So historically, these are very cheap valuations. But obviously, this is happening for a reason. So let's talk about what's driving this company down right now. The first reason, in my opinion, is the recent change in investor sentiment around AI-driven growth. Investors think that companies, mostly big tech companies, are slowing down their AI infrastructure spending, and therefore thinking that all these advanced semiconductors aren't going to be needed as much, and therefore the reliance on ASML, is lower. So how do I personally view this issue? As of right now, there really is no sign of big tech slowing down. And in the last quarter, they spent more than they ever have on AI infrastructure. And we even had the, CEOs of both Amazon and Google saying that they have so much demand that they really can't handle it. If we take that a step further, I personally think that these companies are still building towards something more than just large language models or LLMs. And the next stage in AI will require so much more compute, and they have billions of dollars ready to spend on this, people call it the AI arms race. And then if you think about the next couple of stages in AI after that, We have robotics, autonomous vehicles, a shift to solar, and just an overall change in our world where everything is, becoming electrified. And all of those devices will require semiconductors. The second reason I think the stock is, down recently is because of rising tensions with the US and China. And ASML is based in the Netherlands, and the Dutch government, which is pretty heavily influenced by U.S. policies, imposed restrictions on the export of advanced chip making equipment to China. Now, in 2024, Chinese sales made up 36% of ASML's revenue. However, that was largely due to slower demand from other clients. So they were really, fulfilling more orders in their backlog. And a lot of those were in China. Listening to their guidance on their earnings call in the last couple quarters, they're really expecting those Chinese sales to make up around 20% of their revenue in 2025. So again, how do I think about this issue? Simply put, I see it as kind of a short-term issue, to be honest. Just because chips can't be made in China doesn't mean that, production will stop and the need for semiconductors will go away. In fact, this could be seen as a positive for ASML because, semiconductor manufacturing facilities will need to be built outside of China, which is actually already happening. Right now, we have facilities being built by Intel, TSMC, Samsung, Micron, and Texas Instruments in the US. But regardless of all that, just think about the long-term trends in our world, like I mentioned earlier, like robotics and autonomous vehicles and all that. I'm not going to be able to accurately predict how the short term will play out, but I am very confident in the long term. And at the end of the day, I'm willing to endure some short term pain. And with this one, I'll keep increasing my share in the company all the way down. Next up is Amazon. And Amazon is down just over 13% year to date. And at these prices, we're almost down to my cost basis on this one. I'm almost back to break even. After adding to Amazon more last month, this is currently my second biggest position at almost 11%. I started buying Amazon over a year ago, and the company really shot up to $250 a share so quickly that I felt that I needed to hold off on buying more. Until recently, of course. As I said, I was buying Amazon last month, and I will continue to add to my position this month, and probably as long as this company is trading at these low valuations. Amazon now has a forward PE of 29 and a 2-year forward PE of 25. Let me know if you've ever seen Amazon this cheap in your life, because I haven't. If we look at the metrics, Amazon grew their revenue by 11% year over year in the last quarter. If we look at free cash flow, again, just like with ASML, Amazon's free cash flow is a little lumpy. And recently it has been declining, but that's largely due to their heavy spend in AI. And if we look at EPS, it grew 90% year over year in the last quarter. So that really just shows us that when they decide to start focusing on profits, they can generate massive returns. And again, what I think is likely to happen once they focus on profits and they start generating those returns, they're going to eat up that EPS so quickly. So the forward estimates by analysts are going to be so low. And in reality, this company is likely going to be way cheaper than we thought. I think Amazon is pretty much indestructible at this point, and they have so many fast-growing businesses that will likely continue to grow for decades to come. So let's filter this just to their e-commerce solutions. So we take away everything but first-party online sales and third-party seller services. This business really benefits from the continued shift to buying products online, and their Prime Day sales break records every single year. This biggest part of their business is growing just over 8%, or grew just over 8% in the last year. If we look out a little further, it was growing a little faster, but it's slowing down a little bit. If we move on to AWS, this almost $108 billion business is still growing over 18% per year. And the margins of this business are really high. The margins are 37% as of the last quarter. They continue to focus on Prime Video more and more every single year. And if we've learned anything from Netflix, I mean, if you've seen their stock price recently, that can be a really profitable business once you reach scale. And Prime Video obviously lumps into their advertising business, which is growing almost 20% a year. And advertising is one of the best business models in the world. And with some of these other bets, they're expanding into pharmacy deliveries now and really disrupting that industry. And all of this is under the umbrella of Amazon Prime that, most people can't imagine living without at this point. This company has decades of growth ahead, in my opinion, and the valuations we're seeing right now are some of the cheapest we've seen ever. And in my opinion, any dip in this company is a great buying opportunity. So that's why this has become my second biggest position. The fourth and final stock is Google. Year to date, the company is down just over 17%. I started my position in Google just last week, so I'm a very new investor in Google, and it's currently my smallest position, but I really just couldn't ignore the low valuations. Google has been facing a ton of criticism recently, and therefore it has traded down to a forward PE of just 17 and a 2-year forward PE of 15. The price movement of this stock almost indicates that this is a company that is dying and going out of business. However, if we look at the metrics here, let's look at revenue. The revenue is still growing almost 14% every single year. For a company as massive as Google, that's pretty amazing. If we look down at the free cash flow, again, just like ASML, just like Amazon, free cash flow is a little lumpy because of the increased spend in AI infrastructure. If we look at the EPS, really strong growth. In the last quarter, they reported almost 37% year-over-year growth. And that's largely because the company has been taking advantage of these low valuations and buying back billions of dollars worth of shares. And Google recently started paying a dividend. If we go down to the dividend chart, you can see that they have 4 quarters of dividends paid. And if we look at here, the return of capital chart, this is what I'm talking about. They've been using these low valuations and buying back so many shares. We can look at the shares outstanding here too. Just look at the decline in the total outstanding shares. If we look at the revenue split down by segment chart, and we take out everything but Google search, their business that is under attack, this tells us that this business is not dying or failing. The numbers still don't show any weakness, and there's still really good growth on a business segment that's bringing in like $54 billion. When we think about LLMs, ChatGPT and Grok and all those, they all provide answers in a totally different way and for different types of things. And at least for myself, when I use both Google and I use ChatGPT and Grok sometimes, the things that I look up on both or each of those is completely different. So I think in a lot of ways, LLMs just kind of grow the overall search market instead of just disrupting Google search. I just made a whole video on Google, so if you want to hear me go in depth on this company, go watch that video. But in that video, I brought up something that Joseph Carlson, which is another YouTuber, has been saying about Google recently. And essentially, the argument is that the search market is very poorly defined. Google search is compared to Bing and Yahoo and these search engines that no one really uses. And this whole thing has always been pitched as Google holds 90+% search market dominance. But as Joseph has been pointing out, there are so many other players in the search market. When you think about Amazon, there's a search bar there. People go to search for products that they want to buy. They directly compete with Google. You think about Reddit. You go there for answers and opinions. And when you go there, you don't go to Google. You have Facebook when you want to look for like local news, or if you want to buy something locally, join a group or whatever, that directly competes with Google. And there are a ton of other platforms like that directly compete with Google. So that's why the argument is that the search market is poorly defined. And in reality, Google doesn't hold this massive dominant position over search. And just like Amazon, Google offers cloud services and is one of the big three cloud service providers. So if we switch this to Google Cloud, Google Cloud is growing even faster than Amazon's AWS. Obviously, it's not as big, but as of right now, it's scaling much faster. And just look at that growth, 30% growth per year. So this part of their business, along with YouTube, YouTube TV, Waymo, which is a long shot at this point. We don't know how much revenue that's going to generate. All of these businesses are growing. So even if Google search does decline a little bit, you have so many other businesses within this company that can pick up the slack. And with the release of their latest AI model, Gemini 2.5 Pro, they've really told everyone that, they are a leader in AI. If we go down here to the benchmarks, they're beating all these other models in, various tests, when they're being compared to OpenAI, Grok, DeepSeek, and so on. And if we go back to Waymo a little bit, currently it's a very small part of their business, right? But it's the only autonomous vehicle provider on the road today. And if we look at Uber here and look at their revenue, you can see that there's a clear shift to, paid rides. And this is a rapidly growing market. And if Waymo continues to be the only player in this game, which I don't think is likely because you have other providers coming out with their own vehicles. But if they're able to partner with Uber and start taking a percentage of this revenue, over time as this grows, that could be great. And I'm honestly very optimistic about this opportunity moving forward. Lastly, if we look at the valuation of Google, if we go down here, valuation, again, price to earnings, in the past 5 years, the company is almost trading as cheap as it was during the 2022 crash on a price to earnings basis. But obviously, with this one, you have to think about all the regulation risk. What if LLMs do come in and disrupt their search business? These are all things to consider, but I'm willing to take the risk on this one. And by the way, if you want to learn more about the regulation risks and how to think about that, go watch my Google video. But those are the 4 stocks I'm going to prioritize buying this month. And I've been really, making some outsized deposits to take advantage of this dip. Let me know what stocks you're buying this month in the comments below. But that'll be it for this video. See you in the next one.